Hi guys, welcome to this week's episode. Once again, my name is Pet, the manager at Deriv Trading Academy. Today we are going to discuss and learn about the structure of the market. And please remember that at Deriv Trading Academy, we offer free signals for Deriv's synthetic indices. And if you are interested, just subscribe to our Telegram channel via the link on the description. We also offer mentorship program for those who are passionate and willing to learn how to trade synthetic indices most profitable on their own. And if you are interested on the service, just email us at the email provided on the description as well. And please, if you'd like to get notification whenever we upload a video, make sure you subscribe to the channel and click on that notification button. And may you please like this video and share to whoever you think would like to see this information. You already know the aim. The aim is to assist as many individuals as possible. Okay, let me take care of your screen. All right. Let me go there. All right, this is where we are. So guys, with the structure of the market or the market structure, one of the most important skills that you need as a trader is the ability to read the market structure or the structure of the market. It is a critical skill, or it is a very important skill that will allow you to use the right price action strategy in the right market condition. You are not going to trade all the markets the same way. You need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior. So I hope you already know what is a market structure. It is the study of the market behavior. And if you can master this skill, when you open your chart, you will be able to answer the following important questions. What the crowds are doing. So you will be able to answer the question, what the crowds are doing. Who is in control of the market? Is it the buyers or is it the sellers? What is the right time and place to enter or to exit the market? And when do you need to stay away? Through your price action analysis, you will experience three types of markets. Three types of them. But today we are going to touch a little bit of the first one. Okay, let me just give you these three. The first one is the trending markets. The second one is the ranging market. And the third one is the choppy market. We don't need the third one, but then we need to be able to identify the third one so that we don't get in or we don't get in anywhere near the third one, which is the choppy market. So we do nothing in a choppy market. We don't even include it in our weekly chart analysis. And we don't even include it even on our daily chart analysis. Not even on our crash and boom strategy that that is already available on our mentorship program. Okay, now let us go a little bit deep into trending market. Okay, I hope you're still with me. Let me just try and zoom in so that you will see what I'll be talking about. Trending markets are simply characterized by a repeating pattern of higher highs and higher lows in an uptrending market, and lower high and lower low in a downtrending market. Let us check what do we mean by that. Okay, as you can see, this is we are on our daily time frame. As you can see, from this, okay, let me put it like this so that we'll see which portion am I talking about. You see from this day up to this day, before this whole thing here happened, what was the trend there? Right there was a it was an uptrending market. That was the type of the market that was happening there. The type of the synthetic indices market. It was uptrending market. Now, where are those higher highs and higher lows? This, okay, right there. This is your higher high. 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 And somewhere there, that was your higher high. And do you want to know why we call it higher high? The reason this one is the higher high is because it was higher than the previous higher, which is why it is called higher high. Higher high. This one is higher than this one. And then this one is higher than this one. And then this one is higher than this one. And this one is higher than this one. So those higher highs, that simply means this high is higher than the previous high. And this high is higher than the previous high. That's how we see an uptrending market. So let us check on a higher low. Can you see this? Okay, we can say this one is our low. Okay. And then, okay, let me just check. Okay, somewhere there is our low again. But then looking at this, okay, let me just drop this one. Drop this one here. And take this one there. Okay, this one here is our low. But then what about this one? This part here? Or let us take this part here. Okay, let's take this one. Okay, this one is higher low. Why is it higher low? Because it is higher than the previous low. It is higher than the previous low, which is why it is called higher low. Ladies and gents, make sure you get that because it is very, very important. Before you can think of getting or before you can think of executing a trade, you need to make sure that you understand the trend that is happening there. You need to make sure that you know, or you need to make sure that you have identified the type of the market that you are entering. Okay, so this is the uptrending. Then what happened that other day, during these days? What happened is that the resistance. Okay, we're gonna talk about the support. Okay, yeah, I mean the support. We're gonna talk about the support somewhere next week. I'm gonna teach you how to draw this support line and where to put your SL. Okay, but that one I think we're gonna talk about it later today on this session. I mean, okay. So from this period, let me take this one. Okay. Okay. So here we are. Here we are. From this period here, from there to there, from all these days, I don't know how many weeks are there or how many months are there, but then during this period, something was happening there. What was it? The sellers came into power. The sellers came into control. So, you can see, as you can see, during this period, the sellers were in control. Then the same thing happened there. Okay. And then on a downtrend, what we have, because on an uptrend we have higher high and higher lows, but then on a downtrend we have a lower high and lower low. Lower high, what does that mean? You see, this one is our high, but then this high is lower than the previous one. This high is lower than the previous one. But then what about the lows? This low here is lower than the previous low. This lower here is previous the lower low. You see? So with that being said, that means in a downtrending market, what we have lower highs and lower lows. I don't know if I can write it, put it somewhere there. Put it somewhere there. There. Lower high. Yes, no capital. Lower high. Right there. This is your lower high. Just make sure that you can see that. Oh, okay, when I zoom in, it's a disaster. All right. This is your lower high. Okay, I'm just gonna put this 2 only because you're gonna see what I'll be talking about. Then we're gonna go to our lower low right there, and let me put another one, maybe the last one. Okay, which is another lower low. Okay, so on a downtrending market, you have lower high, and then after that you have lower low. Lower high, lower high, lower high, lower low. Okay. On an uptrend, you have higher high, higher low, higher high, higher low. Okay. So, with all this information that I have given you, clearly you have seen that you do not need an indicator to decide if it is bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trend. Okay, if you are able to identify this, then you know where your market is going. If you are able to identify this, then you know where your market is going. But then again, remember this one. Time frames are very important. Time frames, repeat that. Time frames are very important. You cannot identify a trend or the type of market using smaller time frames, such as maybe H1 or M15. I know most people like M5. I don't know why. Maybe it works for them, but then I'm not the one to criticize or condemn. So here's what happens. Whatever you see there, let us go to our weekly time frame and see if we see the same thing. Okay, this is actually boom 300. What does our weekly time frame say? It actually says this period there was okay, I don't think we need this one. But then yeah, we are there. This part here, it was uptrending and then downtrending. Okay. So yeah, let us go back to our daily time frame. Let's zoom out here. So trending markets are easy to identify. Do not try to complicate your analysis. Just use your brain and see what the market is doing by using the knowledge that I have given to you. Okay. If it is doing a series of higher highs, okay, and higher lows like this one, then you already know that it is an uptrend market. If it is making a series of lower highs and lower lows like this one, lower highs and lower lows, then you already know that it is a downtrend market. Okay. So to determine whether a market is trending or not, you have to use a bigger time frames, such as H4 daily time frame or the weekly time frame. Okay. Never try to use smaller time frames to determine the market structure. You do not do that. Okay, otherwise it will be useless. It will be pointless. So if you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, now you have identified that it is a bullish market, then what are you waiting for? Can you wait for a sell opportunity on a bullish market? You cannot. You cannot. What you have to wait for is an opportunity to buy. Okay. It is an opportunity to buy because you have to trade with the trend. You do not want to go against the trend because the trend, your trend must be your friend. Okay. And if the market is bearish, you have to look for a selling opportunity. If it is like this, you cannot expect a buy opportunity on downtrending market. Okay, you cannot do that. All right, but then the question is, what is the right time to enter a trading market? Okay, what is the right time to enter a market? Trading markets are characterized by two important moves. Remember that? Trading markets are characterized by two important moves. The first move is called the impulsive move. Okay. And the second one is called the retracement move, where it retraces or retest, if I can put it that way. Okay. So let's say from these examples there, and there. Yeah. From here to there. Like, okay, let me see if I can get an arrow just to show you guys, just to make sure that we are all on the same page. Oh, where can I get it? Okay, there's an arrow. Where can I get this triangle? Let me check. Okay, it is not there. I normally don't use these things, so I think that's the reason I'm getting lost. Okay, yeah, there you are, I think. Okay, let's take, for example, from, no, man. Okay. So it is from this point up to this point. So they say this point, it is impulsive movement. When it goes back a bit, that's retracing. When it goes up again, that's impulsive. When it goes back, that's retracing. Goes up, impulsive. Go back, retracing. Okay. All right. So we have given the fact that trending markets are characterized by two important moves. Those moves are the passive move and the retracement move. Professional traders, or those who knows how to trade, okay, or those who understand how trending markets move, they always buy at the beginning of an impulsive move and take profits at the end of it. Remember, I said this one was your impulsive move. This one is your retracement move, impulsive move, retracement move. So, where do you think we should buy? On an impulsive move or when it retraces? Obviously, we need to buy at the beginning of an impulsive move, as you can see. But then, as for me, if you've been following me, then you know that when I get into a trade, I don't do the get in, get out, get in, get out, get in, get out. When I get there, I just wait for a certain time. You know, with my strategies that I have a weekly or swing strategy, and then the daily trading strategy and the boom and crash strategy. With the weekly strategy, I normally don't close up until I have a chance to lock. So if you're a professional trader and you know what you're doing, what I would normally do is to enter somewhere there. Whenever I have a sign to buy there, then I buy. And then when it does this, I wait for it. Maybe I just lock, or when I enter there, okay. Let's say, for example, you execute a trade there, you enter here, right there, and then where do you think your SL should be? Of course, it should be somewhere down there. The reason I don't put it exactly there, why? Because I know the market that it sometimes maybe go back there a bit and then go up. So, which is why I know when I put it down there, I know that if my SL is hit, then there's no way it will go against me, like go up. Like even if it goes up, then there will be a little bit of confusion there. That will show that I should have been out. Not this thing of maybe be kicked out of the market and then just watch it to go your direction. Now, all right. So I put my SL there. When it does this, and then it goes up again, that's where I move my SL from this point to somewhere there. Now I can safely say that my trades are safe. My trades are safe. Whatever happens to the market, I will come out a winner. Even if I lose, I will win. That's what I mean by saying we can lock our trades now by moving our SL to such and such point. Okay. So, as I say, that professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profits at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and it retraces before it makes another impulsive move. Okay. So if you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Okay. Traders who buy an uptrend market at the beginning of a retracement move, they get caught by professional traders and they do not understand why the market hit their stop losses before moving in the predicted direction. Okay, which is why most of the time, let's say I did not get in on this day right there. I did not get in after this daily candlestick closes. And then I did not get in. And then now it is up there. I want to get in. If I get in there, that means I cannot put my SL to be down there or somewhere there. I have to go all the way down to this point. And then a little bit below that point, then put my SL there. And then whatever happens there, I will maybe lose negative 45 or maybe negative 30, by the way. Which most of the people, that's where they run away. Go. Now they think, now you know what, this is a bad trade. I'm getting out. Only to watch me make money after that. If my SL is hit, there must be something that I learn from that. All the time. I sometimes like it when my SLs are hit because that's where I get to learn something new. That's where I get to update my strategies or on my rules. I have to write something there that I need to edit and put something else there. So that's why I learn the most. That's why I love SL so much because when your SLs are not hit, you tend to think that the market is your granny's place, which is not good. We are not related to the market. No one. Even if whatever your surname is, you are not related to the market. So we are there to take money and then leave. And the market is there to take our money. So it's either you kill or you get killed. You better kill, my man. Okay. All right. Now, traders who buy an uptrend market at the beginning of a retracement move, they get caught by professional. All right. We already said that, as I've mentioned. This is what I was trying to say. That if you get in maybe at the retracement, when it is now retracing, then your SL, you must be wise where you put your SL, because your SL is very, very important. Knowing where to put your SL is very, very important. Very important, that one. Very important. I do not want to lie to you. Because if you don't know where to put your SL, you might maybe buy there, as it is. Maybe buy there and then put your SL there, only to watch it get hit and then watch the market go up. Now you are left behind. Now you are sad. Now you think someone did something to you that we don't know. Now, all right, we don't want to go there. Now, if you try to sell in the retracement move, you will be trapped by professional traders and you will lose your trade. Okay, just like I've said. All right, now we know how to identify downtrends and uptrends and how to differentiate between an impulsive move and a retracement move. This is very important for you as a price action trader to know. Okay. But the most important question is how to identify the beginning of the impulsive move to enter the market at the right time with professional traders. How do we identify those moves? How do we identify? How do we know that now they are beginning? Now this is the beginning of a impulsive move, or now this is the beginning of a retracement move. How do we do that? Now, to predict the beginning of the impulsive move in a trending market, you have to master drawing support and resistance. Repeat that. You have to master the drawing of a support and resistance. And guys, I know in this business, in this industry, we all think we know something. We all think we know something. I know that we can all say we know how to draw the support, the resistance, only to find that we're making a mistake. This is the market. Even if you are a master, you make a mistake there. We learn each and every day. That's the reason. That's part of the reason I like trading so much. We learn each and every day. Even if you think you've graduated, you still need to learn. Even if, I don't know, whatever that you think of yourself you are in this business, you still need to learn. Okay. All right. So, how do we identify the beginning of the? Now, to predict the beginning of an impulsive, we have to master how to draw the support and resistance. So, what are support and resistance level and how to draw them on our charts? This is what we're going to find out next week, same place, same time, because I do not want to take too long, because like some other people are coming from work, some other people are busy with other things, so I don't want to take that long. I just want to make it quick so that you finish while you still want some more. But then what's more to come? We're about to finding out how to draw the support and resistance on our charts. And remember, we did nothing on a ranging market. We're still on a trending market. So there's still more to come. Make sure you catch us next week. Same place, same time. With that being said, our session have come to an end. Thank you very much, guys, for watching. Have a blessed night. Thank you. Thank you, thank you, thank you. All right.